Hello and welcome to Novatti's September quarter update webinar. I'm Tony Farnham from the Capital Network, and I'll be the moderator for today's event. Bit of housekeeping. Attendees will be on mute during the presentation. Do have the opportunity to type in questions during the course of the webinar. Time permitting, these questions will be answered at the end of the formal presentation. I'll now pass you across to Mark Healy, who is CEO of Novatti, who will run you through both the achievements of the company over the September quarter and also as well its longer-term growth plans. Over to you, Mark.
Thank you, Tony, and good morning, everybody, and thank you for joining the Q1 update today. It is certainly an exciting time at the company. We are working through a period of major change, an opportunity to reposition the business. For those of us following closely, you'll know that we're 12 months and well into a turnaround under the new management team. We have a very focused strategy and goals, and we're continuing to execute strongly on that strategy and showing consistent results quarter on quarter, which I'm pleased to talk to today. Okay, just a quick recap on who we are and why we exist. Novatti is a B2B focused digital payment solutions business. In short, we enable businesses to both pay and be paid, to receive payments and to make payments. This is a really simple but very important positioning statement. The payments industry has many PSPs or service providers of different shapes, sizes and specializations. Novatti is different through the two-sided nature of our proposition. We have a range of products and services supporting all payment types across the end-to-end value chain. Going forward, we are very focused on serving medium-sized businesses and the software and platform providers that serve those businesses as our target customer. We also sit across both the Australian and New Zealand markets with equal propositions. So what does that actually mean in terms of our offering and our go-to-market approach? As a company, our goal is to be the leading total payment solutions provider across Australia and New Zealand. As I mentioned, the industry has many providers, but most are largely monoline or are focused on one element of the end-to-end payment value chain. The Novatti difference, our strength and our competitive advantage is our full payment stack and our ability to offer comprehensive solutions right across the value chain. The language, the technology and choices across the various payment domains can be very confusing for business owners. The problem we're solving is to remove the alphabet soup of different providers and technologies that medium-sized businesses tend to accumulate over time in different parts of their business and across different sales channels. Our value proposition is the simplicity and the completeness of an end-to-end offering through a single relationship and a consistent experience. We can offer a full range of payments processing and acquiring services across all merchant sales channels, online and in-store and mobile. We are a principal member of Visa for issuing a range of digital, physical and virtual payment cards for many different use cases, both directly to businesses and also to other fintechs. Most businesses now have some form of cross-border trade, importing or selling overseas, and we offer global currency accounts and FX services for cross-border payments. We also provide traditional account-to-account and direct from bank payments, both for direct debit subscription and real-time payments on the new payments platform. We also have very strong relationships with all the Asian wallets, Alipay, WeChat Pay and UnionPay, and provide both merchant acceptance and consumer bill payments direct from these wallets. This end-to-end capability is very difficult to build or replicate. Our challenge and the opportunity we are working on is to bring this ecosystem of process, product and platform capabilities into a seamless experience aligned tightly with our target markets and customer needs. As I've said many times, historically the company was a portfolio of independent businesses without any effective cohesion or synergies. Under new leadership, the strategy is to reorganize and focus on our strengths. The strategy has three simple and overlapping elements. First is to simplify and streamline the company around a total payment solutions offering in Australia and New Zealand. Second is the shift from a sales-led product-focused mindset and mode of operating into a market-led customer-focused business and to improve our cross-selling and integrated approach. And third, a pivot to a profitability focus and to reposition the company's governance and operations towards operating profitability as the near-term goal. So in summary, the business is now very focused on payments at our core. We are positioning in market around the value proposition of total payment solutions, and the whole business is focused on consistent execution month on month, quarter on quarter. Our number one short-term goal is to reposition the business to positive operating cash flow. We have been streamlining and continuing to optimize our operating model through 2024, and we've removed $7 million of annualized expenses to date already. I can announce today that through ongoing product simplification and efficiencies, we've identified a further $2.8 million in annualized costs to be removed in Q2 of FY25. We are targeting partnerships with software and technology platforms as an indirect channel for market entry and a pathway to scale for our payments distribution. Post our strategic review, we now have a portfolio of assets and businesses that logically sit outside our core division of Payments ANZ, and these are available for divestment at an appropriate time. Success on this front will provide the board with capital management options, albeit my intention is the ongoing reinvestment into our core AUNZ division to continue accelerating our growth. In summary, all of these measures and our actions to date help underpin the drive towards our target of positive operating cash flow in January 2025 on a go-forward basis. Some more detail here on the suite of actions through Q1 to execute the strategy, and just calling out some of these. Around simplification, we've recently been successful in selling our majority stake in the banking business from our investments division. Also very important to note that alongside the cost reductions, we've been undertaking selective reinvestment back into the business. For example, we have recently introduced technologies for workload automation, data management, and BI. And we expect to see the first implementation of this next month as we go live with a single consolidated onboarding process within our core AUNZ division, which will improve our efficiency, but also deliver a much enhanced customer experience alongside the speed of onboarding. On our market-led customer focus, there's been some great work undertaken on a brand refresh to reposition our messaging around our new value proposition and our key strengths, and we expect to launch this no later than January 2025. We've also been integrating the marketing, sales, and product functions to work in a more agile and integrated way around market entry into our target verticals. In terms of lifting our financial performance, by simplifying and streamlining our business, we've shown we are able to carefully reduce our expenses without impacting our growth drivers. As I said, we've significantly reduced our expense base through calendar year 24, and in Q1, our normalised net cash outflows were a 48% year-on-year reduction versus Q1 in FY24. As I just mentioned, we've also identified a third round of cost reduction and have commenced removing a further $2.8 million in annualised expenses in Q2 of FY25. Post the quarter end, we've announced a capital raise to support the new strategy, bolster our balance sheet, and assist in clearing some historic liabilities. In terms of some results around Q1 specifically, we can see very clearly the progressive outcomes of our turnaround strategy. You can see clearly here that our financial metrics are all heading in the right direction. Our revenue is up and our costs continue to come down. Q1 was another record revenue quarter of just under $13 million, which is a 26% year-on-year improvement for Q1. We've removed $7 million in annualized costs already this calendar year, with Q1 OPEX a 29% decrease in expenses year-on-year for the Q1 period. And on a normalised basis, net operating cash flow, cash outflow dropped again quarter on quarter versus Q4 of FY24. You can see very clearly here in the graphs on the right-hand side that our operating leverage is being improved quarter on quarter, and we're rapidly closing in on the turning point for the business. We acknowledge there is more to do. However, the team is demonstrating consistent parallel execution of growth and cost reduction to help support our pathway to positive operating cash flow. Now, specifically in terms of quarterly cash use, whilst the headline number is negative 3.9 million, on a normalised basis, it is much less as several historic liabilities were dealt with to improve our working capital position and to strengthen the balance sheet. These additional cash outflows were a combination of one-off year-end costs, the removal of some legacy liabilities, and historical ATO payments. On a normalised basis, without these items, cash use was negative 1.8 million, a decrease on the prior quarter, and also much improved year on year, representing a 48% decrease in cash use versus Q1 of FY24. As recently announced, and also subsequent to quarter end, the company has announced a capital raising comprised of a 2-tranche placement and a pro rata rights issue to raise up to $9.4 million. The raise will support the new strategy, bolster our balance sheet, and support the roadmap to continue to simplify and streamline the business. Looking ahead, the pathway to cash flow positive really has 2 primary drivers. Firstly, ongoing actions on the cost base. The further 2.8 million in annualised cost savings in Q2 comes as a result of consolidation of our commercial functions and teams, efficiencies from process automation inside the business, further streamlining of our technology services, and reduction in our office footprint and expenses. And the second driver is obviously continued growth from existing and new accounts. Our commercial strategy is now targeting mid-sized businesses and the software platforms and partners that support those businesses. Both require a high-trust partnership, shared commercials, and tailored payment solutions, all via a single relationship with Novatti. And from my experience, that's a very powerful offering and key to our future go-to-market. In the back book, we're also working very closely to ensure appropriate margins through more regular review and benchmarking accounts against performance and risk drivers. Just lifting our eyes beyond the next quarter and on the broader market opportunity, Novatti is exceptionally well positioned to benefit from the future structural and behavioural changes around digital transformation. With very clear changes in consumer preferences, we are moving into a world where most payments will be sold and embedded via integrated solutions. Most SME businesses in Australia are still very early in their own digital transformation and enabling digital payments technology. Some University of Sydney research last year showed that nearly 50% of Australian businesses accept the need to improve their payment systems, and over 80% of medium and large businesses believe payments are a critical enabler to their digital transformation. What does that mean? Well, it means that we are facing into a market that is ripe for change and adoption. That's a big tailwind for Novatti's midterm growth. We can help customers transform their payments via a single relationship. We effectively enable our customers to operate their businesses more efficiently with their ability to deliver total payment solutions via the breadth of our offering. How are we positioning around that? Well, this slide shows our 4 operating divisions and the Q1 contributions. A core business of payments AUNZ, an international business that primarily serves Malaysia and Europe, our tech solutions pillar, and our investments pillar. Some general themes to call out here. The payments AUNZ business is still very young. Really, it's only 3 years old, but is already our core and contributing the largest in gross margin, and this continued in Q1. This is a clear future growth vector for the company, and growth here will enhance over time as we focus our marketing, our roadmap, and our customer aggregation in this area. All elements to the right-hand side of payments AUNZ remain under strategic review for both optimization and potential divestment activity to streamline the portfolio. Our international payments division comprises the highest revenue but the lowest gross margin contribution, given current product market dynamics in these regions. Our tech solutions is a combination of several billing companies and several legacy software implementations that have a very sticky client base and provide a positive bottom line result to the company. The future mandate around our investments pillar or businesses that we've incubated is they must be self-funding or provide a suitable economic return. The bank was an early divestment candidate from the ongoing strategic review. We undertook a substantial process to identify options to create value from Novatti's interest and ultimately landed on a sale that was completed in July for $2.87 million. Importantly, our AUDD stablecoin business is self-funded through to Q4 of FY25 and is also currently generating circa $40,000 per month in operating revenue while it continues with its seed funding round. To summarize and conclude, we are now deep into Novatti's turnaround, demonstrating clear improvements quarter by quarter to simplify, streamline, and lift our financial performance. Novatti today is a vastly different business to the company that I took over in Q1 of FY24. We are making exceptionally good progress, growing revenue and reducing our costs. In the coming quarter, we'll have a brand refresh ready to launch by the end of the calendar year to boost our market awareness and penetration. We'll continue to work on reducing expenses with another $2.8 million to be reduced in Q2. We will continue to work on improving margins to progress towards our 3-year target of 70+%. This won't be linear, but we have recently initiated a major infrastructure project to reduce our variable costs in our acquiring business as the next major step change here. We will seek to close out our capital raising at the November AGM to continue the turnaround strategy and transformation. We remain very focused on our target of positive operating cash flow for January, leveraging further cost reduction through the second quarter. And we will continue to focus on optimizing the portfolio with further divestments expected to continue. And with that, I'll conclude my remarks, Tony, and open the floor to questions.
So there's been a couple of questions around your return to positive operating cash flow, and also as well your sharp expectations, a sharp improvement in margin. And the questions are asking, is a lot of that going to be cost out? And how much of it going forward is going to be through successful growth in your business operations?
Yeah, really good question. It goes to the core of the turnaround strategy, really. So there's no one specific answer there. What we are doing as part of the strategy is to seek to apply all levers across the P&L as we reposition the business. And so that's a combination of continued growth, both through the existing book and net new customer acquisition. That is accelerated through the drive to improve the gross margin inside the business. As I said before, that won't be linear. There's a range across the portfolio. We have a range of gross margin contributions in the various kind of areas from 3% to over 90%. And so, but in that core payments AUNZ division, which is the core vector of growth, it won't be linear. As I said, we've just introduced a major project as the next major step change there to reduce the COGS in our acquiring business, which should liberate and release circa $1 million of variable costs out of that business, for example. So margins is an ongoing improvement towards our 3-year target of 70+%. And then ongoing reductions in cost. And so we've got the Q2 FY25, $2.8 million of annualized cost to come out. And so leveraging all of those things will drive us towards that point of turnaround in terms of the operating cash flow position.
Okay. And there was a question there as well in terms of the cost cuts. How are you ensuring that that's not going to be impacting your growth potential?
Yeah, so the experience thus far is that it hasn't. So you can see that we've conducted 2 rounds of restructuring this year, enabling us to remove $7 million in annualized cost out. And all through that process, we've continued to grow revenue inside the business quarter on quarter. So I'm very conscious of that. We've been very considered as a management team in terms of where and how we restructure and we liberate those costs, primarily off the back of efficiencies and simplification and streamlining of the business. And so that's a very acute consideration. And thus far, we've been able to achieve that, and we expect that to continue.
You're talking about your market-led strategy. There's been questions around what have been the highlights so far and which areas do you see as future stars going forward in that area. And we're talking about verticals and just new contracts.
Right. So I've been in the payments business both here and overseas for about 20 years, and it is a very competitive landscape. My experience to build a successful business and to scale that business, you've really got to find segments and niches and have a unique value proposition to drive deep market penetration and customer alignment. And so that is exactly the pathway that we are on in that core payments AUNZ business. You've seen that in terms of the market-led, customer-focused approach, we've continued to drive revenue and continue to drive margin out of that core division already. And in terms of some of the successes that we announced today in the Q1 announcement, things such as the extension of our China payments business into New Zealand and the immediate uptake of that to a large accommodation provider in our target education vertical. We are working very closely with two online food ordering platforms across Australia and New Zealand to scale our merchant acquisition in our merchant acquiring and merchant acceptance business. We've seen recent growth and extension in a major card issuing program for an accounting services business from Australia to New Zealand, and the recent contract win for a tier one major global airline to upgrade their digital experience around their payment vouchers. And so all of those were fantastic wins for the business and just reinforce the continuing ongoing success of that reframing of the business into a market-led, customer-focused approach.
And in terms of your payment side of your operations, there's two questions relating, well, I think interrelated. One is, what's the CapEx requirements for that business going forward? So you're using that as a growth generator. And the other question is, how much of the growth occurring in payments is going to be organic, and is there going to be M&A in there as well?
So unlike a lot of other technology businesses, technology-based businesses, we don't capitalize our software development. So we don't have a significant depreciation drop through to sit off the back of that. And so the expectation that I have through the course of the business over the coming quarters and getting to that turning point around achieving cash flow positive is that there isn't a significant CapEx requirement. And then once we're at that position, we then have a stable platform for growth, which is then largely organic. In terms of the inorganic question and kind of how we think about that, what I would say is for those that understand the market in Australia and New Zealand, it's quite fragmented. And I believe in terms of the M&A opportunities, they will arise over the medium term through the next sort of 1 to 3 years. And we will consider those at the appropriate time, but we would expect to play a role in that consolidation.
There's a question here about capital management as well. As said in your presentation, capital from asset sales potentially opens the way for capital management options. What options are top of mind here?
Sorry, I've just got some background noise here, Tony. Did that come through? I didn't quite hear the question. Would you mind repeating it?
No, that's fine. So you talk in your presentation about any surplus capital from asset sales potentially
Yes.
opening up the way for capital management options. Mm-hmm. What options are top of mind here?
Well, as I said, we do have a kind of a wide and diverse portfolio of assets that sit outside that core payments AUNZ division. We have successfully concluded 2 exercises there in the sort of preceding 12 to 15 months around our stake in Reckon and the bank stake. And we've continued to kind of look at opportunities to streamline the portfolio and to find opportunities to divest some of those assets. In terms of the capital management options that liberates, then, as CEO of an exciting business with an exciting potential in terms of growth in our target markets, then, my desire and recommendation of the board will always be to reinvest that back into the business. But ultimately, that will be a decision for the board at the appropriate time.
I see no further questions on the list at this particular point in time.
Excellent. Well, I think we can wrap up then. Thank you so much, everyone, for your time. Mark, if you have any concluding statements, please let us know, and appreciate everyone joining us.